Bring in our halftime headliner today. Ed Yardeni is the president of Yardeni Research. He's back with us once again. It's nice to see you, Ed. You know, I was looking at your note that you put out today, and I was wondering what happened to the Ed Yardeni of March 7th when he said this. I want you to listen to this. Yeah. Let's watch it, and then we can talk on the other side.
Sure. Since the war, I think stagflation is the scenario that's probably most descriptive of what we're starting to see and what we'll see in the next several months, which is higher inflation than we thought before the war and slower economic growth.
But now what happened to that guy? Because you were worried about, you worried about stagflation. Today, our conclusion is that it's still a bull market and that you see 5,000 to 6,000 of the S&P next year.
Yeah, stagflation isn't necessarily bearish for the stock market. I mean, clearly, it's associated with the Fed raising interest rates, and you can see that since March 8th, thereabouts, right since early March, we've seen the bond yield go from 2 to 2.5%, and yet all the stocks that were supposed to do poorly in that kind of environment, particularly technology stocks, have actually done remarkably well. What I'm saying is a more stagflationary environment, which means slower economic growth, 2.5%, and inflation is going to be more persistent. It's going to be higher for longer. But you know, one of the best hedges against inflation happens to be stocks. Earnings, well, we know revenues keep up with inflation. And the remarkable thing is companies are still holding on to their profit margins. And so earnings are also going up with inflation. So rising inflation is actually not bad for corporate earnings. My concern was that the valuation multiple will take a hit. And instead, the valuation multiple has popped right back up to almost 20 times forward earnings for the S&P 500. And a lot of that has to do with the stocks you've been talking about, the mega cap 8.
But that doesn't necessarily mean that it's justified, Ed.
Well, you know, I don't get moralistic about these moves in the market. I'm very impressed with the fact that the market has rebounded from its March 8th low in the face of certainly lots to worry about. There's Ukraine, inflation. I mean, I've listened to you make a list of all these issues, and yet the market continues to do well. At the end of the day, it's PE times Z, and the earnings outlook is still very good. Analysts continue to raise their expectations for earnings, and the valuation multiple, it's a tough call, but clearly, I think we're seeing a tremendous amount of money coming to the United States on a global basis because all these geopolitical disturbances have kind of maybe switched gears from TINA. There is no alternative to TNOC, which is no other country but the U.S. that has the kind of economic stability, financial stability that we have relative to the rest of the world. So I pay attention to the market as you do, and I'm very impressed by the market's resilience in the face of what should have been bad news. The yield curve, the 10 to 2 yield curve being flat. The bond yield going up, and yet look how well the stock market's doing. I think we have to consider the possibility that investors are looking at stocks as inflation hedges.